Çok saygıdeğer Maliye Bakanım, sayın milletvekillerimiz ve saygıdeğer misafirlerimiz, İstanbul Finans Zirvesi'nin ikinci gününe hoş geldiniz. Dün olduğu gibi bugün de birbirinden seçkin konuklarla tekrar bir aradayız. Öncelikle açılış konuşmalarıyla başlayacağız zirvenin ikinci gününe. Günün açılış konuşmasını yapmak üzere Bank for International Settlement CEO'su Jaime CARUANA'yı sahneye davet ediyoruz.
Good morning, Minister, Governor, ladies and gentlemen. It's a real pleasure to be here. Unfortunately, I will have to speak in English today, but it's a pleasure to be here, and I thank you very much for inviting me to this important conference on this very interesting topic, navigating through global low growth and low interest rate environment. A few days ago, you already know, G20 ministers and governors met in Ankara under the very efficient chairmanship of the Turkish presidency. And if you read the communique, I find very interesting one sentence that it will be a little bit the thrust of what I am going to say today, which is monetary policy alone cannot lead to balanced growth. And I think this is an important sentence, and I fully agree. We at the BIS have always and have often discussed the importance of a very strong and resilient financial system, the critical importance of the measures that were taken by central banks in different countries to counteract a very damaging and very difficult and complex crisis. But we have also talked about the risks from keeping interest rates low for very long and for relying too much on monetary policy to foster growth. However, if we look around 7 years after the financial crisis, we must recognize that still the configuration of this very low level of long-term interest rate worldwide is really unusual, continues to be an unusual configuration that probably indicates that the policy mix of reaction to the crisis has been and remains unbalanced, in the sense that we continue to rely in many places, and I'm talking here globally, I'm not talking about any particular country, I'm really taking, as the BIS is a global institution and global perspective, but generally speaking, we continue to rely too much on monetary policy stimulus, while progress in the structural reforms and the emphasis on the structural reforms probably has been insufficient, at least insufficient for the needs of an economy that is still in a difficult situation, in a very complex crisis, a balance sheet crisis, which is a different kind of crisis that requires a lot of repair and reform as the main instruments. Of course, interest rates are not just the result of monetary policy. It is also the result of the beliefs and perceptions and expectations of market participants. And I think this is one of the reasons why it is important to discuss this kind of issues as it is done in this conference. Now, again, we have talked a lot of times, and many people is talking about the benefits of low rates. I would like to argue that we need also to consider what are the risks associated with persistent, and a key word here is persistent, low rates for a long time. And the risks to financial stability have been at the forefront of this message that we have been conveying for some time. Particularly important is in balance sheet recessions that are a result of a number of financial imbalances that accumulate over time. So I don't want to bother you with all what we have said in many annual reports and conferences, but let me summarize a few points that we have made consistently. First, one of the concerns that we have is that is leverage and search for yield. By reducing the cost of leverage, by reducing rates, keeping it for long, and increasing the incentives to search for yield, we can, persistent low rates can contribute to excessive risk-taking and to the buildup of financial imbalances and increase financial stability risks that can harm sustainable growth. risk-taking is good, and it is good that it happens in the real economy, but it is not clear that persistent low rates is going to generate this kind of investment, which is the important point on the real economy. And we have seen that sometimes it goes somewhere else to the financial sector. Low rates could lead also to the, and that's my second, the postponement on unpopular but necessary structural reforms and reduce the incentives for deleveraging and repair balance sheets. In the financial sectors, it can lead, for example, to encouraging evergreening, meaning it reduces the opportunity cost of carrying non-performing loans and not writing-offs, which is something that you need for healthy growth. Low rates, my third one, can cloud market signals, can large-scale interventions in financial markets may distort and degrade some of the signals that are necessary for investors and policymakers. Central banks can become too dominant players and distort, and even in some cases atrophy some markets. And again, these distortions can undermine the role of the risk-free yield as a benchmark to guide investment decisions. What investments do not look profitable with interest rates so low at a global level? But we want investment, but we want also that good investment that are resilient and that are profitable. Fourth, it can undermine the financial sector operating profits, and in some cases it can affect solvency. We know that happens in the bank when low short-term interest rates and a flattened yield curve can erode some of the earnings. And it is even more clear in the case of the pension funds and life insurance companies that may have some much more difficulties to meet their long-term obligations and even impair their solvency. But even if you think about retirement, even households targeting a desired level of retirement, a desired level of savings for retirement, may need to save now more, which is probably the opposite of what interest rates try to achieve, which is to spend more, but they may need to save more to achieve the same target of investment. So I think we need to think about all these elements. And finally, another element that we have sometimes highlighted is that exiting from this policy of low interest rates may be somehow difficult and create a further set of challenges. Now, today, that was some of the points that we have made on different occasions, and you can follow that in our annual reports about financial stability. But it is not just financial stability, and today I thought that I would like to focus on a topic that we have developed this year on the BEIS annual report, which perhaps has received less attention, and it's the negative impact of credit booms on productivity. This is another way by which low interest rates for long, to the extent that they create or contribute to these credit booms, could affect productivity. And again, the spirit of my talk is very much in the objectives of the G20. It's to emphasize the importance of productivity, to emphasize the importance of investment, to emphasize the importance of a financial sector that can provide with the necessary finance, but perhaps not exaggerating, not going too fast in this providing, and in an economy that is able to facilitate innovation. These are themes that are now at a core of the G20, and I think these arguments that I am going to elaborate go in this direction. Now again, the buildup of credit booms that can be influenced by low interest rates is a very slow process. It's a very hardly noticeable process, and therefore it's not in the same frequency of the decisions that central banks have to make when they make the decisions about monetary policy. It's not the next day decision or the next week decision. It's a slow process, but it is a very consequential process that again strengthens the need for monetary policy not to lose sight of these issues and not to lose sight of a medium-term perspective. So the key issue is the balanced policy mix, balancing more two reforms. Now, central banks, you may say, have always paid attention to productivity, but by and large, they have always considered productivity a factor that they can't influence. It's like the weather. You cannot influence the weather. This is, in the economic jargon, an exogenous fact. But the truth is that weather was an important factor determining what should be monetary policy in the past. And there is this nice story, I don't know if you have heard about the Bank of England. You probably know that there is a nexus between these things that you cannot manage, such as weather and monetary policy. You know perhaps that in 1805, long time ago, the Bank of England connected the weather vane that is on the roof with the room, the curved room where they are deciding monetary policy. And if the wind was coming from the east, then that meant that ships would be soon arriving to London, bringing new goods and new products. The bank would need to supply more money for the traders to be able to do their trading, and therefore they were easing monetary policy. Now, if the indicator, if the wind was blowing from the west, then the boats would not be coming to London, and then the bank would need to mop up this kind of excess liquidity from the system so that there was not too much money chasing for a few goods that would mean inflation. I mean, what the Bank of England did at that point of time was to react appropriately to changes in the direction of the wind, which is equivalent to the productivity shocks, to control inflation. What the Bank of England could not do is to change, obviously, the direction of the wind. This is, they could not change the direction of the productivity shocks. So these elements of this very basic insight contributes to modern monetary policy. Central banks still take a keen interest on productivity because obviously the efficiency with which inputs can be turned into outputs determine the potential output of the economy. However, like the weather, the evolution of productivity is considered exogenous, and the central banks and economists consider that the long-run determinants of productivity are basically structural, is education, is innovation, is research, is development, and this is the right way to approach. But today, drawing on some analysis that we have done, I would like to show that some of these credit booms can, to some extent, affect the reallocation of resources and can impair productivity growth if this is persistent for some time. We have done some analysis. This analysis is basically on advanced economies, but I think the conclusions from the advanced economies can be extended rapidly and can serve a useful insight for emerging economies. Now, aggregate productivity can grow from essentially two reasons. One, individual firms can become more productive, but there is another way, which is that resources in the economy, such as capital and labor, can shift from low productivity firms to high productivity firms, boosting the aggregate productivity of the economy. And this reallocation of resources is quantitatively very important. Just looking at labor, about 1/3 of the aggregate productivity growth in advanced economies arises from this kind of shifting reallocation across resources. So this is important. Since the financial crisis, the trend growth of productivity, labor productivity, has fallen by around 1 percentage point. In advanced economies, the slowdown in productivity is not new. It started really well before the crisis, and the causes and consequences of this decline have sparked a lot of debate, including among central banks. The financial crisis has highlighted the role of finance and credit in productivity growth, and some research has examined the role of impaired financial intermediation in the productivity slowdown after the financial crisis. And surely monetary policy affects credit, and hence it is likely to be a link between this and productivity. So what I would like to do is to acknowledge first that this monetary policy could affect reallocation in either direction. Easing credit frictions by lowering interest rates is often thought to enhance reallocation, helping successful entrepreneurs to expand more quickly. However, I would like also to show that monetary policy can also hinder some of this reallocation. Again, although lower interest rates can increase the access to credit for all firms, monetary policy easing can also benefit some sectors more than others. Specifically, credit constraints are relaxed more in sectors with more collateral, for example. It can go more to construction, real estate, financial services. These not necessarily are going to be the highest productivity sectors, or they can benefit firms that benefit incumbent firms over new entrants, weakening some kind of the dynamism. As a result, while easy monetary policy could boost output in the short run, at the same time, this easy credit, and to the extent that create credit booms, weakens total productivity growth. Some sectors could end up being too large once the boom turns into bust. These sectors need to shrink and need to reallocate resources, something that is really slow. It may be painful, and it requires flexibility in the economy. Are these misallocation effects because of credit booms significant? Our figures suggest that they are. They are significant and they are persistent. Our analysis looks at a number of advanced economies, and those advanced economies that has had a boom, a credit boom, in the run-up of before the financial crisis, their productivity growth from the period 2004-2007 was cut by some 0.4 percentage point per year, which is a significant amount. But it is perhaps more interesting to see that after the crisis, the cut of productivity growth was 0.6%, which is almost between 1/3 and half, which is a significant amount every year for a number of years. So I think the important conclusion that I want to draw from here is that we need to pay more attention to the interaction between monetary policy, credit, and the real variables such as productivity in the medium run. We should more carefully examine these issues of misallocation and low interest rates, which can be very long-lasting. Again, I will not repeat, this is an analysis done on advanced economies, but the story can be similar to emerging economies. And after the crisis, we have seen how some rapid credit growth has happened in some emerging economies, and I think this is something that it will be useful. These insights will be also useful for these economies. And again, this is an analysis that we have done, but recently I have seen similar impact or similar attention to productivity in Bank of England or Bank of Spain, where they have analyzed how these credit booms have affected their productivity. Now, let me conclude. We have, in our past annual report, emphasized that current low rates, we don't consider these low rates a new equilibrium rates. I know that there is a lot of talk about new equilibrium. We think that low rates cannot be considered equilibrium rates if they create financial instability or they create inflation. Inflation in most countries is not an issue because global factors have weakened the link between domestic conditions and inflation. So before low rates can generate or bring inflation, they are likely to generate financial stability risks. It's very difficult always to pinpoint how these risks can manifest, and there are different channels. Nevertheless, in the light of the productivity slowdown and the significant impact that this slowdown can have on standards of living, the impact of monetary policy on misallocation and productivity deserves more attention. And in this low risk, low growth environment, policymakers should not lose sight of this medium term. So from my perspective, navigating through this low rates, low growth should be towards a more normal configuration of interest rates and supporting growth with structural reforms and innovation and a strong and resilient financial system that would favor investment in the real economy, taking risks in the real economy. This transition from where we are to this more normal structure of interest rates and policies more focused on structural reforms may be bumpy, and we have seen some of these volatilities, but delaying this process can also have costs, and I'm thinking in the medium term, and persistent low rates raises the risk of financial instability and also chronic weakness in our economies. Thank you very much. Again, thank you very much. It has been a real pleasure to participate in this summit. Thank you for the invitation.